Well, hello everyone, and welcome to our Sustainability Masterclass here at the Yale School of Management. My name is Keith Gallinelli. I am the Director of Admissions for our MBA for Executives program. And today we're very happy to have three distinguished guests join us. So we're going to be doing the math, exploring the evolving field of ESG financial modeling. And so with that, Professor Cort, why don't I just turn it over to you? You can do a quick introduction. We'll have all of our panelists introduce themselves, and then I will come back.
All right, thank you, Keith. Hi, everyone, and welcome to the masterclass today. As Keith said, we're going to be talking about ESG financial modeling, I think, as one of the most important trends that's going on in sustainability today. My name is Todd Cort. I'm one of the faculty members here at the Yale School of Management. I teach in the sustainability area. I also direct the sustainability track for the Executive MBA. So for those of you who might be interested in joining the Executive MBA and taking sustainability classes, you'll meet me in person and learn a great deal about sustainability while you're here. I'm also one of the co-directors of the Yale Center for Business and Environment. And I teach mostly classes in sustainable investing, sustainable finance, and corporate sustainability. We're also joined by my co-guest, I guess. Karl Pettersen is one of our alumni. I'll let him introduce himself in a little bit, and also Stuart DeCew, who will be moderating. So, Karl, would you mind introducing yourself, and then Stuart?
Certainly. Thank you, Todd. And pleasure to be here and great, great that you can make it. So I'm Karl Pettersen. I'm a Yale alum, class of 97 undergrad. And I've been in the finance industry for about 30 years. I'm currently managing director at a company called Scope Ratings in Berlin, which is the leading European credit rating agency. And a lot of the work I do is to look at how corporate ratings are assigned and evolve, and how corporate credit risk moves essentially. And one big leg of this type of research is what the translation mechanisms are between the entire climate and sustainability conversation, and then different layers of financial risk and corporate risk. And we're doing this here at Scope Ratings under the auspices of the European Central Bank and European regulations. So very much a live project with a lot of eyes on it. Prior to that, I ran my own business for a few years called Pettersen Analytics. It was really about figuring out that arithmetic that takes us from climate to really deep corporate finance, and how to make it happen for a CFO essentially. And prior to that, I was in banking for a long time. I was chief sustainability officer of a large investment bank for a few years. I was an advisor to a lot of large corporations in Europe and in the US. And prior to that, I worked I started my career in credit and in econometrics, and wrote a number of risk methodologies that are for better or for worse still in use in the market today. So I'm delighted to be here. And with that, let me hand it over to Stuart.
Great to see everyone. Thank you for being here. Stuart DeCew, the Executive Director of the Yale Center for Business and the Environment, which is the joint initiative between the Yale School of Environment and the Yale School of Management. I'm also a lecturer at the School of the Environment. And as of today, I'm also the inaugural director of the Planetary Solutions Impact Accelerator, which will support faculty innovations from lab to market for us to be able to commercialize more of the technology from the kind of world-class research that comes out of Yale Labs. So I get to focus a lot at Yale on the early stages of ideas, working with faculty and alumni and students and others. Where do we put new ideas and needed ideas into curriculum? Where do we support the earliest stage companies that are in around? Where do we take the best from Yale and bring it out to the world? And really what you have here today, and what I'm thrilled to join you and moderate this, is we have world-class alumni who are generous and thoughtful and want to see systems change in ways that help the planet, like Karl. And you've got people like Todd who are applied faculty members with feet in and out of the university, both right at the leading edge of the market, and then also at the leading edge of kind of pedagogical design, curriculum, and making it work for people who come back here and learn, who are bridging these worlds. And so we're going to have a really fun conversation today. Keith is going to kick us into how do you think about the program? What are you able to do in this? Get through the nuts and bolts, and then we'll dive into mind melding Karl and Todd into a conversation at the leading edge of sustainable finance and see where we get to.
Excellent. Well, thank you guys so much for joining us today. Yes, as mentioned, I'm just going to go over a very brief overview of the MBA for Executives program, and then we're going to dive right into our sustainability masterclass. Definitely have the opportunity to ask questions. You can use the Q&A function in Zoom to do that. We'll try to get to your questions either throughout the course of our talk or towards the end as well. And then finally, I'll come back with some next steps. So I think that it's really important as we kick things off. We always go into the mission of the School of Management. This really is very, very important to everybody here that's part of the program. It's a mission that means something to the faculty, the students that are here. We're educating leaders for business and society. This is where people come, where they want to they want to build their leadership skills so they can be making impactful contributions into their communities, their organizations, their companies. And I think that really fits very nicely with our talk today on sustainability. As we think of who would be a student in our program, it is for experienced leaders. These are people that are mid or even later on in their career. They've had some management experience. They're maybe technically expert in whatever that field is, whether it's medicine or chemistry or engineering. But now they're taking on maybe more business roles, and they have identified some gaps maybe in their education where they want to take advantage of that. And so we're looking for people that have had this career evolution. They've got a strong trajectory, again, taking on larger projects, maybe managing more people, trying to think about more strategically how they want to move forward in their career. And this really gives people that career acceleration and access so they can continue to grow on a larger scale. The program itself is an in-person program primarily. We have one cohort that joins us every year. They start off in July with a 2-week residency, and then it goes to an every other weekend format, Fridays and Saturdays between August and May. In between years 1 and 2, there's a global network week, there's another week of residency, and then it goes back to that every other weekend format. There is the ability to be remote on occasion. We do know sometimes it is harder to travel to campus, so there is that option, but primarily people will be here on campus. As we look at the curriculum, I'm going to only talk about this very, very briefly. We have a lot of other webinars that go into detail about all of the things that will happen during year 1 and year 2. But in general, in year 1, this is where all students, regardless of their area or their background, will be taking our integrated core. These are classes that are organized around stakeholder perspectives, things that maybe are a little different than other business schools. So you're not taking a class in accounting or strategy or finance, but you're taking classes called the customer, the competitor, sourcing and managing funds. So kind of a little bit more broad view of how an executive would see their business. As I mentioned, in between years 1 and 2, students have an opportunity to travel around the world through one of our partner schools in the Global Network for Advanced Management. When you come back, this is when you have the opportunity to take a deep dive into our electives and advanced management courses. We have 3 areas of specialization: asset management, healthcare, and today's focus, sustainability, where you can either take a deep dive or you can take more of a general management approach. Throughout the entire program, there is a colloquium speaker series. And I know, Professor Cort, you're one of the people that helps to try to curate all of these speakers. These are experts in their field. They come, they have, a little bit more intimate conversations with our students, asking lots of questions, taking a deep dive into their areas of expertise. And of course, leadership development is built in through the entire course. So again, very, very brief overview of the program. I really want to get into our conversation, so I'm going to turn off my screen share. I'm going to turn it over to you, Professor Court, and allow you to kind of kick off our conversation.
Thanks, Keith. Stuart, you want to kick us off?
Yeah, I mean, yeah, so let's, setting this up, like a period of time of massive transformation in the field of sustainability, energy, and the environment over the course of the past, 25 years. Like we've seen a revolution in the energy industry about how we generate and produce energy across the globe, massive shifts in the kind of way that we're bringing new capacity online, dollars that have moved, industries that have been created, And then a whole set of kind of roadblocks and challenges about where we'd be able to kind of continue to see this trajectory accelerate and continue. What we want to get into today is like really the role of finance, financial structures, the way that we think about the practitioners and the leadership that's needed inside of organizations to be able to make the correct cases, be able to put it into terms that people can utilize and understand, and that can shape and move really large sums of capital that are out there that potentially are not being applied or deployed in the ways that we might think would be optimal. So let's start, Todd, with you. You know, you spent 20 years in like consulting, working with tons of really big companies prior to coming to Yale. You've been teaching here for over a decade. Like, how are you seeing the kind of field right now of sustainability evolve? And like, how are you responding to it in your own teaching and work?
Yeah, it's a really important question, I think. So let me give it a little bit of context from my perspective. So 30 plus years of experience in this field. We've seen, as you say, massive transformations, like particularly in the energy transition, in our understanding of risks and opportunities and sustainability. And a lot of money has moved. And yet, I think we can safely say that we are failing still. We are failing to protect those systems that business and economies and nations depend on. Systems of climate, systems of biodiversity, of natural capital, of social capital, of economic inequality. These systems continue to be stressed and continue to fail. And the consequences of that are going to be dire. So I tell my students, there's only two ways to sort this out. Actually, I should back up a little bit. There's only one agent in society that has the capability to figure this out now, and that is markets and business. Governments are I think of them as the direction, but business is the engine. Right? We know the direction, but we need the engine to push us forward. So I tell my students there's only two ways to do this within business. One way is to completely rewrite capitalism and say that capitalism is no longer about just financial capital. It has to be about environmental capital, social capital, intellectual capital, et cetera. And that is a good thing to work toward in a meaningful way. But in the meantime, the only other way to do this is to price these risks appropriately. Because markets, and I'm parroting Karl here, he taught me this, markets don't move without price. So the question now is, in the face of this failure, this broad failure to act quick enough, how do we appropriately price these climate or biodiversity or inequality risks and opportunities into the balance sheet of whatever financial product we're interested in, whether it's a debt product, like what is the risk of climate induced default on lending products? What is the risk of climate induced collapse of supply chains on cost of goods sold? We have to price this information into the way that we think of our balance sheets. And that's what this conversation is about. So there's a long way of getting around to answering your question, Stuart, which is how have I tried to change, or what have I seen to change the way that I teach and the way that we think about this in the classroom? We used to talk for years and years and decades. In my first 6 years of teaching at Yale, we used to talk about the business case of sustainability, right? Things like, if you build a good company, the employees will come, and you'll have to pay less for those employees because they'll want to stay with your company. Or there's a risk of supply chain disruption, and so protecting against that through climate change mitigation is a good thing to do. But the reality is that that was all hand waving and an indirect allusion to the balance sheet with no suggestion, modeling, or quantification of how it would actually be accrued to the company. So I changed and said, you know what? If we're going to make this happen, we're going to have to teach every sustainability practitioner out there that's interested in business how to do financial modeling. And we're going to have to teach every financial modeler out there how to integrate environmental and social risk. That's what's changed. So now I teach a class that we used to call metrics and sustainability. Now it's called pricing and managing sustainable assets. To get right to the point, how do we price these things? Because price moves markets.
Yeah, and it's really refreshing to have when you hear Todd introduce the concept of do the math, people's kind of eyes light up and like sort of get the concept immediately when it's put into those like clear and simple terms. Um, so Karl, Todd's outlined the kind of way things are shaping for him. How are you seeing the world and the conversation over your long career in finance? And what do we need most today? Like when we get into the details of what Todd is saying, the kind of calculations and math that's needed, like what do you need to see in the market and inside of organizations being done?
Yeah, perhaps to segue as smoothly as possible from what Todd was saying, and to try to put numbers on it. Uh, First, I think Todd, you're right. There's been enormous amounts of capital that have moved, and we've talked about it a lot. I think the latest figure I have in mind is a bit outdated, but in 2024, I think it's something like north of $2.5 trillion moved towards green energy globally, a record high. Blah blah blah. Also, it's two-thirds short of where we need to be, right, in order to get where we want to get to. So there's this real sense of, yes, there was all this hand waving. I think you called it in all this initial enthusiasm, but then there's a roadblock. And so, what is that roadblock really, and what is it that we need to do? And I think there's several ways to think about it. And perhaps the most straightforward way is to think about it in terms of cost, right? Which is when you look at the cost of the energy transition, right? If we just focus on energy transition, it's astronomical, right? There's a very well cited report by McKinsey that puts the price tag for the world at $275 trillion, right? To put that in perspective, that's a hard number to countenance for a human brain. There's kind of recurring research by BCG that measures the amount of money on planet Earth, right? And that's somewhere between 250 and $300 trillion. So there's a good shot the energy transition costs more than all the money on Earth. It's also equivalent to the sum total, to 8% of the sum total of all the goods and services ever produced by the human race. The numbers are huge. I spend a lot of time in Europe. I split my time between New York and Berlin. A lot of the work I do here is based in Germany, and certainly the European view was, well, governments can really help and can have this top-down approach to funding it. The problem is balance sheets are so completely stretched at the moment. At the sovereign level, we see this all over the place. Everybody's budget deficit is out of control. That really, it's only the private sector now that can do it. But the private sector hasn't figured it out. And there's a number of reasons for that. One, just to connect to Todd's comment that it's ultimately about markets, and markets only move with price. They don't move on the basis of moral imperatives. They don't move on the basis of political aspirations. We see this in the US, right? The Trump administration can say drill, baby, drill. They don't control oil prices. Oil prices decide whether you drill or not. Um, this sense that the climate response is really about energy in many ways. Energy is driven by global energy markets, millions of actors that decide where prices move, or where capital and physical assets are allocated. So being able to crack that nut is hugely important. And that brings us to maybe another way to conceive of the issue, is that in the initial, let's call it the more awareness raising phase of the climate conversation, the phase where everybody is signaling their enthusiastic embrace of commitments to decarbonize, et cetera. There were a lot of curves that were shown on, this is how we decarbonize, right? Oh, first we go to solar, then we go to EV, then we go to hydrogen, then we go to whatever. The issue you have is when you place this in the bigger global market context, that's just a technology curve, which is useful, but it's not enough. You need to have the same curves on the economics of it, on the finance of it, i.e., how the risk is allocated, on the geopolitics of it, because energy is intensely geopolitical, right? We go to war about this stuff, and on the political and consumer experience of it, because markets are also designed to pass the cost down to consumers. And in anything that vaguely aspires even to resemble a liberal democracy, consumers are voters. If you campaign on the basis of impoverishing your consumers, you will get voted out of office. So a lot of that math needs to be done that unites all this stuff. And so perhaps in terms of what's needed, and this is also me giving a long answer to your question, Stuart, but in many ways it's a real Rosetta Stone, right? That takes the language of sustainability and translates it fully into finance. And one of the failings, I think, of the sustainability conversation we have now is that there was an assumption that if the sustainability discourse is loud enough and there's enough of an embrace, it will translate into finance, right? Or finance will learn sustainability. In reality, these discourses, these tools, this lexicon of finance is immense. It's hugely established. It's hugely powerful. Sustainability is a new kid on the block, right? Sustainability needs to learn finance, and because it's a private sector that holds the keys, ultimately, you have to learn deep corporate finance and how to translate back and forth. So, do the math for me is also the Rosetta Stone, and it's also who pays for this ultimately, right? So
Yeah.
that's where it's led me.
That's great. And so, Todd, can you get into this? Is actually like relates to a question we just received online as well from Nikkei, which is, you know, on how do you actually do this? Like, how do you write the Rosetta Stone? Like, where do you take something qualitative? Like, Karl was saying, you had a decade of people talking about net zero with anecdotes and elements and aspirations, and now we're moving into a period where we have to move it into financial models and balance sheets. Like, how does this work?
Yeah. Well, this is, I mean, I'll preface this with if it was a 1 minute answer, then we probably would have done it a while ago. But
Well, if it
the,
was a 1 minute answer, you don't need to come for 2 years to study it in the EMBO program, which is where you're going to get a ton of value out of it. You actually have to dig deep. Like certain things in pedagogy can't be learned quickly. Like this is complicated and difficult. We're only going to be able to do so much in 40 minutes. So I think that like let's start with there and
yeah,
then dig in, man.
So
yeah. So
you're saying it's a 2 year answer, basically.
it's a
Could be
two.
longer. We're still working on it.
So let's start with the basics of financial modeling, well understood.
Thank you.
However, I'm going to put the little asterisk on that, well understood in an 18th century way. So the basics of financial modeling we know how to do, right? And you learn that in the first year of any MBA program. You probably learned it in undergraduate if you were in economics or business major. Um, so why can't I take something like, I know that what severe weather systems are going to increase in frequency and severity over time. Why can't I, as a company, say, well, I'll just price that in, right? How do I take the probability and the potential disruption, which is the magnitude, and just price it into the cost of the goods that I purchase, right? Line item on the balance sheet. That's basically what we're going to do, right? That is on the equity side. That's basically what we need to do. We need to figure out what is the probability and what's the magnitude. But now let's get into the nuance. So on that probability question, there's the probability of the storm occurring. There's the probability that I have goods that will be impacted by that storm, either at the port level or while it's at sea. That may or may not impact on customer preferences over time as a result of that disruption. That I have some sort of diversification of my supply chain that either can or cannot overcome said disruption. That I might have a certain amount on the shelf that can hedge against the price increase from that disruption, or depending on the length, et cetera, et cetera. That's just on the probability side. On the magnitude side, you say that it's a disruption that I'm going to have to pay for it, but the amount of that cost that I am actually going to have to accrue is dependent on a lot of different factors. So translating the reality of a physical world, and this could be climate risk, again, it could be biodiversity risk, it could be socioeconomic risks. There's hundreds of risks from these various other capitals. Translating from the physical world into what I will actually have to pay, or what I think I'll have to pay, or what I can make out of that market under the circumstances requires a large number of assumptions and data sets. And this is where Karl said sustainability is the new kid on the block. We've been making those assumptions with other data sets in the financial world for a long, long, long time. Some data sets are much better than other data sets, but we use all kinds of data sets to try and price assets. The sustainability world is now coming in and saying, well, here's vast amounts of new data that might create price risk and opportunity. We have to figure that out. So we're actually in a fairly unique point of history right now, in my opinion, that the data sets in sustainability, particularly in climate change and energy transition, are starting to get to the point where they're good enough that we can accurately price them. And that wasn't really true 10 years ago, and probably definitely not true in 20 or 30 years ago. So we're getting to this point now where this climate risk data and some other risks, the data is on par with the data that we have historically used in financial modeling. And that's a real nexus. And then the last thing, the last complication to this is this question of, but some of these risks are already priced by the market. And I want to be really clear about how the market can price things. So the market can directly price some risks, but a lot of risks it price based on kind of secondary information, perception, and intuition, if you will.
Mm.
So if I come in and say I have to reprice this asset or this potential cost based on this climate risk, I need to also be clear how much of that risk is already priced by the market. And I need to separate those. So that means that I have to understand how those millions of investors and traders and whoever's are thinking about that climate risk now, and whether or not I'm bringing new information to the table. So like I say, the basics are here, but the really interesting part is how do I get from the basics to this translation of the real risk? And that's where, the data and the financial modeling come into play. So that's why we are, it hasn't been done yet. That's why we're doing it now. The last thing I'll say, and I know I'm taking too much of your time, Stuart, but the last thing I'll say is that my students will sometimes say, but all this data for sustainability, it's really wishy-washy. Like it's problematic, this data. Like I say, some of it I think is getting better, but I would like to remind people that we use wishy-washy data in all kinds of financial risks around the world. It doesn't have to be sustainability. So people are surprised when we introduce, like, here's the data that we used for this, leverage ratio, or this interest rate that we're going to charge, and it has almost nothing to do with the real risk that we're trying to understand, but that's the best that we have, and so that's what we use. So I want to be careful about throwing sustainability data under the bus. That's all.
That's great. So, Karl, like Todd is sort of speaking your love language and saying we're introducing this into the 101. Can you take us into like the 201? Because you've been at the leading edge of this conversation for literally decades. So, like, what does it mean? Like, where does the pricing happen? What is the misalignment? What's being priced well? What do we need to price better?
And again, I think there's several ways to slice and dice the question. So let me give you maybe a couple of perspectives that I think are complementary. First, just a comment on the wishy-washy data. Absolutely, yes. And let's make no mistake, and I think any of us who have worked inside large corporations, large systems, we know this, but a lot of the tools that we use in finance today still are quite rudimentary, let's be honest. And they were created decades ago, and they work well in theory, but they never work well in practice. And then it's all the storytelling you put around it, right? So just to reinforce that point. Yes, what I liked about so there's maybe two levels. One, what I really like about the way Todd explains it in the pricing of things, right, is and how much is priced already is that in some ways, and Todd, correct me if I'm wrong, I think of that as a little bit of almost the equity view of the world, right? Which is a little bit what people do with equity analysis. It's how much of the risk is intrinsic within a price, how much of it is intrinsic risk, how much is behavioral risk, right, basically, and then how much is market noise around it. And you can start slicing and dicing it that way. That connects, if you will, you have the equity side of the world, then you have the credit and debt side of the world. So you have kind of both sides of the balance sheet, so to speak. And it's that same logic, in fact, on that other side. It's that kind of intrinsic and behavioral and more markets view of the world. And I spend more time on the debt side of things, which is, I think, one of the reasons why Todd and I get along so well, because it's the same love language, but we have slightly different dialects, so it makes it fun. But perhaps on this side of things, as we go deeper into kind of 201 and the level of individual corporations, maybe we can think of it in terms of either functionality and then the kind of modeling that we need. In terms of functionality, first, it's, on the debt side, it's going to come in through cost. Basically, what are the costs involved, right? And so you need to understand what the costs are, and even if the data is imperfect, right, it gives us enough of orders of magnitude that we can really start thinking through them intelligently and at least have bands of costs and start to understand where they're going to hit. Now, in a lot of cases, the business case in the past that's Todd alluded to, it kind of stopped there. And the problem is that's useful for sustainability professional. It's kind of worthless for a finance professional because then say, well, what do I do with this? So the next layer functionally is really understanding the financial theory of it, right? And I spent a lot of time working on this, but just like you can distinguish what are the price components of it on a financial theory side of thing, there's a real elegant way of thinking of this, that at some point it starts to become economically indistinguishable from an unfunded liability that's maybe on your balance sheet. And then the question really becomes one of, you have to match your assets and liabilities, because any company that has mismatched assets and liabilities, it's never good. It's often catastrophic, right? So all of a sudden that starts to become a little bit more arresting for a CFO, but that's not enough. Then it's, how do you get into the actual budgeting process? Because you can talk financial theory all day, but when you have a head of procurement and an internal CFO and your head of employee health and safety that are on a Zoom call, well, don't talk, what do we do? So there's a functionality side of thing, and then the mirror image, or kind of the way to translate it again, is to think of it in terms of modeling. And I think that's kind of the topic here, and that 201. So I won't talk a lot on it, but just to go through a few of the layers and how they come together, it's really three or four things together. One, understanding all the costs and how they move. And some of these costs are physical. Some of them are compliance costs, like paying a price of carbon. We were talking about pricing.
Mhm.
So that's one of the market prices that's out there. Some of them are transition costs, like if I need to invest in, small modular nuclear. Everybody was talking about small modular. If I need to build a solar farm, if I need to go and buy new types of assets, you need to understand how these move together, right? And what the common language is. Then you have these costs, and they'll move in different ways, right? And depending on where you put them in the modeling, these costs have very powerful multipliers to them. The reason
Mm.
being that if we talk about climate, and for example, if we talk about carbon, if you delay, it's not just you delay an investment, but you keep emitting at an increasingly higher rate in the meantime. So the cost of you catching up, right, is
Mm.
becomes exponent. The growth becomes exponential. So delaying by 1 year actually means you delay your targets by 3 years, and so on and so forth. So you have to understand all that stuff, and there's a revenue component to it. There's a timing component. There's all kinds of layers to that. Then you can tie that into the liability piece I was talking about. And then finally, I think where it comes together with what sorry, not Stuart, what Todd was saying, my apologies, Stuart, is you start getting into questions of returns and value creation, right? And distinguishing value creation and the avoidance of value destruction. And you take all that together, the different types of costs, the different types of multipliers, the timing, and modeling all that. In all this, there's an efficient frontier that resolves
Mm.
all of these costs optimally and that enables you to speak in budgeting terms very tangibly, and in terms of rank ordering the risks and what's most likely, less likely, what's tangible, what's not tangible, and to make a case as well that you invest now so that you don't have to invest the multiples later. And also, you talk to your CFO in a way of saying, you do this now. If you
Mm.
don't do this, you're blowing up all the rest of this. You don't want to be responsible for that. So you start doing all this kind of math, and then that's an indirect way, if you want, of pricing it, because for a corporation, that starts to give you real internal carbon pricing, and you start to look a lot better than your peers on that. And depending who your audience is, you can use it or not, and then you can start actually being part of the even the political conversation around carbon pricing. So.
It's
Yeah. So Todd, man, so Carl's really focused on these kind of individual conversations that it has to come down to inside an organization where one person is using that Rosetta Stone and translating across multiple functions and areas to make the case. Like, how do you train people that way? Hey, you're about to jump in too, but like, what's the way? Like, what are the ways that we need to build up skill sets and areas? So, and Carl, I'd love for you to jump in on like what you see from chief sustainability officers currently and the people who are trying to make this case, and like where they actually need to go and what the next evolution of this would look like.
there's been a regulatory trend that is pushing this along, but not kind of taking us where Karl and I are thinking. The regulatory trend has been around financial impact disclosure. So for those of you, or those people online, if you're familiar, there's like the CSRD, the Corporate Sustainability Reporting Directive in the EU. There's the upcoming CSDDD. The California has a rule on the books now around climate change risk, SB State Bill 261. There's a dozen or so financial disclosure regulations. And what those have been doing over the last year, plus or minus, because they've been expanding and contracting with different politics. But what they've been doing is they've been asking companies to describe the financial impact of climate risks in particular. Now, describe is different than quantify or model, but it is pushing sustainability officers who are responsible for these topic areas within the company. It's pushing them to start thinking about what are the financial implications of climate change on my business, whether it's transition risk or adaptation or mitigation costs, et cetera, right? Some of the buckets that Karl was just mentioning. It's not modeling. But what I think is important is it's starting to get sustainability officers to do a few things. One is that they need to start thinking in different terms and therefore communicating in different terms. It pushed a lot of people or a lot of companies to start hiring what they called an ESG controller, which is a professional within the organization that thinks about enterprise risk and accounting for enterprise risk and quantifying enterprise risk and asking that person to consider climate change and other sustainability risks in the same terms. And it's also pushing some companies to think, well, as long as, I have to think about these financial impacts, but I still go to the CFO and the CFO still says, yeah, I get it. There could be costs associated with this, but I can't do anything with that sentence. What I need, the CFO needs, is I need some level of comparability. And depending on the strategic questions being asked, I'm going to need different levels of accuracy around that comparability. And I'll just give a couple of examples because Karl was alluding to this. Some questions, I don't need the exact number, right? You could tell me the net present value of my investment in the solar panels and how much those are going to pay me over the next 10 years, say. But for some decisions, I don't need the net present value. What I need to know is whether that solar panel is better than a windmill, or whether that solar panel is better than waiting for a gas-fired turbine, which will come in 7 years. As long as we've got the ballpark on the financial, on the numbers, then I can make a decision. Some are even more broad, like just tell me if we're talking about a loss of $1 million at 80% probability or a loss of $10 million at a 30% probability. Because now I can balance those questions and say, well, which one am I more nervous about as a financial officer or as an executive officer? And then there's some decisions where I actually need the number, right? Because I'm deciding between, am I going to build this new manufacturing plant in this place or am I going to build it in that place? And the difference could be, a matter of less than 1%, return over the life of the asset. I need to know which one because those numbers matter. So depending on the strategic questions being asked, you're going to get, you need different kinds of information. But right now, we don't even come into the conversation with the information. We just come into the conversation. The sustainability officer comes in and says, there could be some serious costs associated with this. Like that doesn't help at the moment. What I need is a ballpark cost estimate, ballpark probability, and I need you to compare it against the way that I'm thinking about this other asset that I'm considering investing in. That's where we need to get to on a lot of these conversations.
Do you mind if I chime
Yes,
in
please.
with a few things, and then let's make this a 4-hour session. Why don't we?
Yeah.
But the no, one of the things I think that's important as well is, let's remember that a lot of chief sustainability officers in corporations come out of public affairs or procurement or even investor relations, things like that. And one of the most important things that they need to learn, and I think this is the kind of topic as well of Todd's classes, is you need to understand the financial identity of the company you're in as well. Some companies just want to do M&A. Some companies just want a ton of debt. Some companies are obsessed with paying down debt, because that's the thing that's kind of make or break for investors, and that'll determine whether they succeed or not. That's the priority. Then a lot of the question is going past the cost, going past the, oh, it's going to cost money if you don't do it, is to be able to say, if you don't do it, it moves your financial identity by this much. I did a lot of work with a company that had put on too much debt because of an acquisition. They were obsessed with paying down the debt, etc. And one of the arguments was say, look, if you don't do this, it's the equivalent of adding 2 billion of debt to your balance sheet. Your all your targets you've promised to the market, they're gone. You will lose credibility. You as CFO, it's your job on the line. That becomes powerful, but that requires understanding the conversation first. And then the other thing I wanted to add was, Stuart, when you were talking about individual companies versus more systemic, this is, to me, if we broaden the aperture and we really take a large view, this is the real challenge. And I think this is what makes it
Mm,
so fascinating and also so cutting edge, in the sense to be having these conversations, is it's a lot about figuring out how systems scale down, right, to the level
mm.
and how to scale back up. We don't know how that works. We don't have a science of that, right? What we know is that it's not linear and it's messy. But this is the kind of conversation, and ultimately, this is what sustainability is about as well, that we really start to figure out what that math is of how these systems move and they scale down. Maybe company by company, and maybe market by market, but ultimately, that's a lot of it is that kind of exercise too.
Yeah, on that, just there's an interesting example that's popped up for me recently on this kind of like systems level understanding of risk where it goes to individual companies and how it's been kind of priced. So, the residential home market in the United States like has a lot of price signals related to insurance that have been out there for a while, and a lot on climate risk that's been put in, and getting real hard numbers on that, and people feeling the pain of really significant increases on home insurance costs that they're seeing. Zillow had a score within their platform to be able to show the climate risk associated with it that they'd had for years. And they've gotten pushback and it actually have taken it off the platform now because one of the best priced risks we understand that can impact the most significant asset that any individual in the United States owns has better risk and harder numbers associated with it. We know a bit more of the information, and we're now actually not showing it or demonstrating it because there are other forces that kind of push us to say we're going to stick our head in the sand. So, like, when you think about this kind of up to the systems level and down to the firm level and getting the right information to individuals, like, how does this, like, that recent scenario I'm painting fit or not fit into the discussion
Yeah.
here? Like, what do we need to do?
I'll jump in. I'll let Todd. Todd, feel free to contradict everything I'm about to say. But to me, there's there's a number of things. I want to touch on this notion of, in a sense, it's a little bit of who's going to give us the information and who's using the information. There's a little bit of that. And to me, it goes back to, there's who pays for all this, but in the question of do the math is who's going to do this math, right? And in the initial sustainability conversation, there was a lot of faith placed in large investors, large funds that would do the math, et cetera. I think part of the exercise is also to understand how these institutions function, right? If you take the largest funds that we have, with the private equity funds, index funds, the Fidelities, the BlackRocks, the names that everybody know, right? These are institutions that have experienced tremendous growth, just breathtaking growth. And also breathtaking economies of scale. Their incentive is to grow, right? To keep growing. So at one point, you become so large that the conversation you have every day has to be political because it becomes about regulation, it becomes about legislation. So
Mm.
in order to grow, you have to align at least somewhat to prevailing political winds, right? So there's a lot of this belief in sustainability that just kind of the moral imperative of it will drive people to do things. I think a lot of the conversation is understanding what actually causes people to act. And so for a lot of people, it's for markets, it's price, but for different classes of market actors, it's different things. So it's having that map in mind and then seeing where you thread the needle, right?
Mm.
So that's where my mind took me when you said this. Maybe it doesn't answer the question at all, but I know, Todd, if you want to again contradict everything I just said.
No, no, I'm not going to contradict. I'm going to express a certain outrage. So, what is the Zillow example? What is actually happening there? So, let's say from the point of view of the real estate agent or the agent association that wants that information to disappear, what are they
Yep.
actually doing? They are saying that I want to raise the price today and push that risk off into the future. That's being nice about that, right? The not nice is I just wanted to hide risk information. But let's assume that the risk will manifest anyway. So I'm just trying to push it off to the future. I want future sales to be lower in the interest of today's sales to be higher because my assumption is if people are afraid of climate risk, fire hazard, flooding hazard, et cetera, they will not pay as much today for risk that could manifest in the future. That's the nicest way to put it. So that's a distortion around discount rate. Um, so in a free market, in a perfect market, a liquid market, that wouldn't be allowed, right? We assume that we can calculate the cost of capital accurately to get our discount rate. And this is a more or less political maneuver to try and distort the discount rate for a liquid market. Um, the I think if I were the real estate association, what I'd be more worried about, rather than better pricing signals, because you in an ideal market, in a competitive market, you want as many price signals as you can get, and climate risk is a price signal rather than being afraid of the information, what I'd be more afraid of is that people see the information without the concomitant price calculation, which is what we're arguing for. Like the normal consumer says, "Oh, I'm in a red zone on Zillow. So I'm going to make up a discount for that price. I'm going to say I'm going to pay 30% less for that home because I'm afraid I can't get insurance, etc." That is a perception-based risk rather than a calculated risk.
Mm.
So if I were the Zillows of the world and the real estate associations, I'd be pushing for doing the math and saying, well, let's calculate what is the actual price, change that we would expect as a result. Because
Yes.
now I can act on that. Now I can, accurately price the market. Now I can push for regulations or incentives or insurance products that try to correct for the market failures rather than trying to hide the information, change the discount rate, and have some sucker down the line pay for it.
But see, I think you said outrage, but it's like focused anger with a lot of expertise and a way of fixing it is a very useful thing. I think also there's like products and solutions and ways of financial structures that can help alleviate some of these issues. There's some really great work by Cameron LaPointe at the Yale School of Management on residential property assessed clean energy loans that can actually lower and reduce climate risks by hardening and supporting homes in specific areas and being able to lower insurance costs. So like the different products and tools we can come up with to actually match and understand those risks are being developed and created as we speak. We just have to scale them a lot more quickly. Uh, So, I know like Karl and Todd, you both mentioned we could talk for 4 hours. I know Keith, and others are going to say you guys have to end reasonably soon because this is what we promised folks. Do you have thoughts on kind of like how Yale can help here? I mean, Karl, from like the Yale network and the engagement of practitioners on campus and us to be able to ask the kind of right questions, do deeper research, and kind of be able to teach people leading edge work, like where can we support and help the professionals that are going to have to be the leading edge of this? As you mentioned before, like the only place where this is going to happen is in the private sector, in corporations. That's where the capital is. Like, if we're successful in training people, like, where can we help?
Um, to me, the what I love about the work Todd is doing, what I love about the work you're doing as well, is what we're missing. Again, if we go back to Rosetta Stones, we're missing that decoder ring, right? That enables us to do that. And even if we think in terms of incentives, right? Why do people do things? Why do corporations want to be the smartest person on the block? Typically, like if I'm AT&T, I want to constantly show I'm smarter than Verizon, right? If I'm Ford, I want to be smarter than GM. If I'm General Mills, I want to be smarter than Kellogg, right? So it's all about where are we the smartest? And the climate conversation, also getting back to data and what Todd was saying, the data is getting usable enough that if you're able to put in the decodering in that blender, right, all of a sudden the level of intelligence you can bring to the market is a very different level. And all of a sudden you're not just say an American company who's talking about Europe. All of a sudden you really can have that global conversation that unites the two. So to me, Yale brings these decoder rings. Yale is one of the few places that actually is working on these decoder rings. And also, what I find wonderful about being at least even tangentially part of this community is the quality of practitioners and alumni you get. I mean, you have chief sustainability officers, chief financial officers, all working to the same thing, all with the same lexicon. And at Yale, there's such a deep culture around this. We were talking about carbon pricing, right? I spend a lot of time in the EU, which is the biggest carbon market in the world. All that stems from Bill Nordhaus's work, right, at Yale. And we have, our Yale Climate Conference every year. He presents every year. So there's such a deep DNA at Yale and such a deep network. On top of that, you layer on kind of, I think, what's truly the most cutting edge approach to things. You're going to be very, very well equipped to not only take the conversation further, but build that network of quality. And if you're a corporate warrior and you go back to your employer, you're going to put them on a map in a different way. So that's my 2 cents.
That's great. Yeah, and Todd, so what does the do the math look like over the next 2 years for people? Or 2.5, the folks applying to this program and then thinking about where they're going to be like, what is Yale gonna, how is Yale gonna help?
So there's a few things that are going on here, and we're also learning as we go, but we're trying to be expert and leading edge in this practice. It's a real focus area for us. So the next couple of years, people will see a much stronger quantification and data-driven approach in the sustainable investing classes that you'll see at the School of Management. And in partnership with some of the kind of world-class environmental economists at the School of the Environment. You'll see the Center for Business Environment, little plug for Stuart and the center, is going to work with these two schools around, doing seminar series, hopefully, bringing in more guest speakers, connecting the dots, if you will, across the university and across our alumni network and other people that interact with Yale around this topic to try and push the conversation. I think you're going to see, this ecosystem of conversation evolve over the next couple of years around this idea of do the math. Obviously, and as much as I love the university here, we're not the only ones that are doing this. So I think it's also important that these conversations happen with the partnerships that Yale is part of. For example, the World Business Council for Sustainable Development is one of our key partners. A lot of the universities here in the Northeast we work with, and Europe and around the world. There's faculty in our global network. I think there's a lot of conversations with other practitioners and faculty around the world that Yale will like to be a part of, and where our students will hopefully engage with us as well. So I think there will be a fair amount over the next couple of years.
Great.
So I just popped on. I know we're getting towards the end of our time together. One of the things from an admissions standpoint, uh, maybe Todd, you can speak to what are the type of students that come into the program and kind of what are the outcomes that you see, as they've gone through it, as they graduated, shifts, maybe advancing their career. What have you seen from students in the past few years?
I always kind of categorize our students into a few buckets. So there's the climbers, people who come in. The MBA is critical to them moving up a corporate ladder, to take on more financial responsibility, for example. Or if you want to be a fund manager, you want to handle other people's money. An MBA is a pretty important degree to have. That's kind of one bucket of students that come in. There's a second bucket, I'll call them the pivoters. These are people who want to change careers or, sometimes companies, sometimes within a company, but they want to do something different with their life. And they're interested in how the MBA can provide tools to make that pivot. And then the third bucket that I frequently point to are the shingle hangers, the people who are going to start their own thing. These are entrepreneurs. They might be advisors or consultants, but they want to create something entirely new. And again, there's another plug for Stuart and his work at the Planetary Solutions, and the entrepreneurship ecosystem here at the universities. There's a lot of people in our executive MBA program who are entrepreneurial in spirit, and want to create new things as they come out. That's on the out, kind of going out. Coming in, we have such a diverse group of people that come into this program. We've got lawyers, we've got existing and experienced business leaders, we've got retired people occasionally, we've got consultants, we've got real estate agents, we've got military and veterans. There's so many different people that bring so many different perspectives into the classroom. There's just no way to put a box on that. I don't envy you at all, Keith, in that selection process.
No, but I would also, there's no way to put a true value on that as well, because like the element of innovation happening at the edges of expertise between people and their experience of coming in, the edges of disciplines that you get to experience here at Yale, which is differently designed than other places for kind of porosity and engagement and osmosis between institutions. Like you have leading scholars at the law school who are teaching in the MBA, the EMBA program. You've got leading scholars from the School of the Environment who are teaching in that. You've got joint degrees who are alumni who are coming back to like lecture in this. People who lead the largest energy markets in the United States, to the chief financial officers of like small modular nuclear companies that are scaling rapidly, to people like Karl, who are at the leading edge of sustainable finance and have been for decades and are drawn from Yale College and 3 decades of experience in doing this. So like it is a remarkable place of where kind of the edges are defined, and that's where all the opportunity is, right? Like if you want to find something that's growing and developing quickly, like go to where salt and fresh water meet. That's where all the fish are. If you want to find out where all the things are like developing, like go to the edge of forest and meadow. Like that's where all the birds, bees, and bunnies live. Like we create those conditions, and the people that come in bring them. And so, like when you see a room of EMBAs, you're like, I'm so lucky to be in the room of people who bring all this diversity of experience. And then you get the conditions of the faculty and the topics that are then blended in there. So we love it here. So we'll be here for the entire time that you're here, and it'll keep being really fun and interesting. So we hope you join us.
It is definitely a fun experience. Karl, any last parting words of advice or wisdom from you? And we'll have to wrap it up in about a minute or so.
Really quickly, so A, do it. It's worth it. But B, also something that always is in the back of my mind is sustainability has been around for a long time. We call it lots of different things. It's sustainability, it's resilience. It keeps kind of morphing. But there's something very profound here, which is it's, again, back to the notion of systems. This is where we're all in our little bubbles of finance, da 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 da. To use Stuart's terms, this is where it all combines, right? This is where it all meets, where finance needs to become something else. That something else needs to learn finance. It needs to become the physical world. The entire concept of sustainability is bringing all these things together, is broadening the aperture. And these are some of the very pragmatic tools that enable you to really figuring out and shine a light on where these connections are and how to use them.
Excellent. I wanted to thank all of you, Todd, Stu, Karl. Thank you so much from the admissions standpoint. Definitely, I put it in the chat, but if you want to reach out, if you have any questions, emba.admissions@yale.edu. We have the ability for you to do a pre-assessment. You can send in your LinkedIn profile, your resume. We'll have a number of in-person information sessions. They'll kick off again in the new year. The first one will be coming up in January, so those are all up on our website as well. Applications, I know a few people had some application questions. I'm happy to answer any questions about those individually. But yes, we have two more rounds of application that are all going to that July start, as I mentioned at the beginning. But thank you so much again for our sustainability masterclass. I learned definitely a lot of things, and especially I'm going to use that example of the salt and freshwater meeting. That's a great way of putting things. But thank you all so much, and for all of our guests today, thank you for attending. Look forward to hopefully seeing you on campus here at Yale University in the near future.